Well, welcome in. We really appreciate everybody joining us. As I think you're probably aware, my name is Chris Patterson. I am a CPA and a financial planner in Jacksonville, Florida, which is kind of why you'll see my ugly Christmas sweater here. Ugly partly because, well, it is just ugly, and then it's the Jacksonville Jaguars, and everything they do right now is ugly. So, just some kind of introductory things before we get started here. So, why are we here? Well, year-end planning is always a little bit chaotic. There's always a lot of things to consider. And 2021 has certainly not disappointed us in that regard. We have a lot of things that we're going to try to get through today. And in addition to some of our year-end planning strategies, we're also going to have try to give you a little bit of an update on where some of the Biden tax proposals stand, also known as the Build Back Better Act. Easy for me to say. So obviously a lot to get through. Couple of just points here. I've got some notes in front of me, so I may occasionally just look at those and look away from the camera. I also have a screen just over to my left, and so occasionally I'll look over there just to kind of remember where I'm at, remember what I'm doing. So as we work our way through this, please feel free to ask any questions. You certainly can type those in just kind of below in the box there. Type those in. We'll address all of the questions at the end of our session here, and but please feel free to throw any questions at us. So, who am I? As mentioned, Chris Patterson, CPA, financial planner in Jacksonville, Florida, just outside of Jacksonville, Florida. Been doing this for about 20 years. I was really fortunate. My dad had a CPA practice for a long time, and I was lucky enough to kind of join on with him. Started off before I joined him, I was in the financial planning world with Prudential and Wachovia, actually First Union, then Wachovia, then Wells Fargo. But then went and joined Dad, and was, like I said, was really lucky and fortunate to have that opportunity. Kind of jumped into the tax and accounting and the audit world, which the audit world was one of my least favorite things. Sorry, Dad. But at any rate, as I worked my way kind of through the tax and accounting world, I quickly realized that the tax and the accounting and the financial planning really meshed together very nicely. And so over the last probably 15 years or so, have been fortunate and have done, I think, a pretty good job of really using kind of detailed tax planning to kind of drive financial planning for clients and really try to provide as much value as I can there. So that's just a little bit about me. And I don't want to spend too much time on that because I really want to jump into kind of the heart of the material here. So we've really got about 5 year-end planning strategies that we're going to go through. The first of those is going to really kind of charitable giving, but we'll dig a little bit deeper into charitable giving. So we'll have, the first thing we want to talk about are donor-advised funds. Donor-advised funds are essentially just a giving account that's established at a public charity. And you can contribute cash, highly appreciated stock, privately held business interests, life insurance, cryptocurrency, oil and gas interests. Point being, there's a lot of flexibility in terms of what can be given. Where we will normally see donor-advised funds utilized is if we have a client who we know is pretty charitable each and every year, but maybe they're not getting above the standard deduction, which obviously is fairly large now. We're, depending on age and some other factors, you're pushing $27,000 married filing joint in a standard deduction. So obviously that's very large. So if a client has maybe an unusually large income event in a particular year, we will utilize donor-advised funds as a strategy to get them up above the standard deduction limitation. The nice thing about donor-advised funds is there's really no limit to how much you can contribute into the fund. Some firms will have some account minimums, some won't. Depending on where you go and how you do it is going to kind of dictate sort of the minimum that you would have to contribute into that. But the advantage is that you can contribute into a donor advised fund, but you as the donor ultimately control when and where those funds go. And that's a huge advantage for somebody who has kind of a charitable heart and also happens to have an unusually large income event, because you can contribute to the donor advised fund, take the tax deduction, and it is an irrevocable deduction. So once those funds go in, you're not going to be able to pull those back out. So it's important to understand that. But with that being said, over time, you can slowly or quickly contribute to different charities of your choosing through those donor advised funds, or a DAF, as you'll hear it referred to at times. So a really valuable planning strategy. And again, most of the time that's generally done if we've got somebody who's giving $10,000, $15,000, $20,000 a year and they have that large income event. We may say, hey, let's expedite these. Let's give 5, 6, 7, 8 years worth of annual giving into that fund so that we can generate that deduction. So again, donor advised funds, really valuable planning tool, much more common than they used to be. And again, if you have any questions on those, just throw those in the chat box there, and we'll certainly address those. I know we've already got some questions on those, so we'll address those towards the end of the session here. Next up, qualified charitable distributions. A lot of folks are already pretty familiar with these QCDs, as they're called. Really, the qualified charitable distributions are an option for an individual to take a distribution out of their retirement account, out of an IRA. The distribution will go directly to a charitable organization, whether that's a church, a hospital, whatever the case may be. You can direct where that's going to go. Where these really come into play is if you are 72 and above, and you're at that point where you have to take required minimum distributions, and it is 72 now. The Secure Act that was passed in late 2019 has changed that, went from 70 and a half to 72. If you are at that point, but you really don't need the money from the required minimum distribution, the advantage of the qualified charitable distribution is you can take it, you can utilize these up to $100,000 per individual. So if yourself and a spouse each have the IRAs and you don't need to take the required minimum distributions, you can each take $100,000 and contribute to a charitable organization. They're not treated as an itemized deduction, so you don't have the standard deduction limitation or have to deal with any of that. And they are not included in your income. So really powerful planning tool, especially again, if you don't need the required minimum distribution. Those QCDs can be extremely valuable because again, with a married couple, you can contribute up to $200,000 if each of you has separate IRAs that would allow for that. So again, extremely valuable. Just as a point of reference, so I don't forget, eligible account types, traditional IRAs, inherited IRAs, SEP IRAs, and simple IRAs. The SEPs and simples do have to be inactive accounts. Pretty rare that we see those QCDs out of those accounts, but just as a point of reference, just so you understand eligible account types there. One other point to reference, as a CPA, as somebody who has prepared a lot of tax returns, if you do execute a qualified charitable distribution, make sure that you let your tax preparer know that you have done that, because the 1099-Rs that get issued by the brokerage firms don't always reference that. And so we want to make sure that we don't include something in income that shouldn't be included in income. Most clients would not be too happy with that. So just simple little word to the wise there on those. So talked about donor advised funds, talked about qualified charitable distributions. Next up, gifting appreciated stock. So a pretty well-known strategy. I think most folks are aware of the ability or the option to gift appreciated stock. So there's a few things to keep in mind here. Number one, you really want to be cognizant of where you are with standard deduction versus itemized deductions, because if you do gift appreciated stock, that's going to be treated as a charitable contribution, which will get reported on Schedule A and would be treated as an itemized deduction, assuming that it's greater than the standard deduction threshold, if that makes sense. The real advantage here is when you gift the appreciated stock, yes, you receive the benefit of the tax deduction, again, assuming that you itemize, but you also avoid the possible capital gains tax on the liquidation of that stock. I will caution you one sort of downside to gifting appreciated stock is if you were to leave that stock just to children, grandchildren, whatever the case may be, you do kind of lose out on the stepped up value and basis at your death. So that is one downside to that. But if you have some stock that you've held on to for a while that has gains in it, and a donor advised fund or a qualified charitable distribution just really isn't an option for you, gifting the appreciated stock is certainly something that you could consider. I will caution you or encourage you, probably a better word, to get with your advisor or your tax preparer to make sure before you actually gift it, to make sure that you're actually going to be able to benefit from the deduction because of the size of the standard deduction being so large. Just want to be a little bit cautious there. But certainly can be a good option for a lot of folks. So in terms of charitable giving, those were the main things that we really wanted to hit on. Donor advised funds, qualified charitable distributions, and gifting appreciated stock. Now I will tell you, each of those strategies in and of themselves can be extremely valuable. And one thing I didn't mention on the donor advised funds, obviously we're within a 30-day window here, before the end of the year. The donor advised funds, qualified charitable distributions, gifting appreciated stock, those are all things that are fairly, easy to set up and execute. So you still have time left in 2021 to execute those strategies if you choose to. Okay. Water break. All right. So let's move in now. I think we're on Roth conversion. Roth conversion plan. All right. So Roth conversion planning. The key word here is planning. So there are really several factors that you need to consider. So one of the most common questions that I get as a CPA, as an advisor, is should I convert my traditional IRA to a Roth IRA? Well, that's really a loaded question. I have no idea. You can't really answer that question in a vacuum. You really have to kind of dig into the details of that. And the reason that I say that is, for one thing, you really need to have a pretty clear picture of how much longer you have until you plan to retire. Or if you are already in retirement, let's say you're 65, 66 years old, and you've still got a 5, 6, maybe 7-year window until you have to take your required minimum distributions, you really want to utilize a multi-year approach with a Roth conversion strategy. It's not just, well, I feel like converting this year and so I'm going to do it. Well, the question I always ask clients is, what's your goal? What do you hope to accomplish by converting from a traditional to a Roth IRA. Obviously, it can be a really valuable planning tool because of the tax-free growth, and you can pull the funds out tax-free in the Roth IRA. That's all fine. But from a tax planning perspective, what we really try to caution and advise clients on is what's the exact number that you need to convert each year to achieve the goal that you want to achieve. Some clients say, well, I don't want to pay any taxes in retirement. Okay, that is a possibility depending on the circumstances, but you need to understand how much time you have left until retirement. Take advantage of the current standard deduction. We talked about how large that is. You actually can have, if you don't have a pension, maybe a military retirement, whatever the case may be, you actually can have about $600,000 to $700,000 in a traditional IRA and still pull those funds out tax-free if that's your only income. And I'm using a very simplified example here. But because of the size of the standard deduction, you could have a fair amount of money left in a traditional IRA. And a lot of clients don't realize that. So you have to understand that. It's also extremely important to understand what your tax bracket capacity is, meaning if you're in the 24% bracket, how much more income can you earn and still stay in that bracket, or how much can you convert and still stay within that bracket? We generally want to try to avoid bumping into another bracket unless there's some circumstances that apply that would warrant it, but understanding your tax bracket capacity. And also, because we're talking about a multi-year approach, whether it's 5, 10, 15, 20 years, we really need to project the potential growth within that account. So that's why I stress that word planning, because anytime we talk about Roth conversions, it really is a plan in and of itself. It can be an extremely valuable strategy, and we'll talk a little bit towards the end about the potential impact of some of the Biden proposals on Roth conversions. But the one thing I would advise you against doing is I want to convert something before the end of the year. I would advise you against doing that. Really get with, if you're a current Lifeworks client, get with your advisor. Or if you have questions about this and you don't have an advisor, you want to just chat with me, that's fine. But you really need to put together a plan around Roth conversions. I can't stress that enough. Okay, yeah, so I think we hit on everything there as it relates to Roth. So let's jump into some tax loss harvesting. So I think, pretty sure most people are familiar with the terminology. You may even be pretty familiar with conceptually just kind of how it works. Really, at the end of the day, all tax loss harvesting is reviewing your current holdings within your portfolio. And just as a word to the wise, I'm sure most of you already know this, but you can't do any tax loss harvesting inside of an IRA, because obviously that's a tax deferred account. Anything that comes out is going to be taxed as ordinary income. So we're talking about just taxable brokerage accounts. Okay. So what we want to do, step one, is just review your current positions. Do you have any losers in those positions? If you do, then tax loss harvesting in its simplest form is just selling those positions that you or your advisor deem appropriate, and capturing or realizing those losses. Okay. Now, once you have sold those positions, it is important to understand there is something called a wash sale rule, which is an IRS rule, which prevents you from reacquiring that position within a 30-day window. So you've got to wait until that 31st day, then you can reacquire that position. One caveat to that, which is important, is the cryptocurrency. It does not apply to cryptocurrencies. So I am by no means a cryptocurrency expert, but I can tell you that the wash sale rules do not apply to cryptocurrency. And so what that means is if you have significant losses in a crypto currency position. You can sell that position, realize those losses, and you can literally reacquire that position back the same day. Now, that is more likely than not going to change with the Biden tax proposals. So if you find yourself in that situation, this year, 2021, may very well be the last year that you would be able to take advantage of that. So just kind of be aware of that. Now, so that's one part of tax loss harvesting. So you've captured the losses, you've harvested them, you've realized them, but they really don't, the losses in and of themselves don't really provide you any significant tax benefit until you have capital gains to offset them. You're going to be limited to $3,000 per year on your capital losses that can go to offset ordinary income. So the next step is to, again, which you probably have kind of already done this, given step one, is to again look through your portfolio within your taxable account, identify if you have any winners that would be appropriate to liquidate now in the current year. And that's really a decision that if you're managing your own money, that's a decision you're going to make on your own, or if you have an advisor, you'll make with your advisor, maybe your CPA. But you're going to want to just review that portfolio, see if there are any winners that would make sense to sell off now, maybe as a part of a rebalancing strategy, and use those to go against those losses that were generated within the tax loss harvesting. Now, if you don't, if that just doesn't apply in your situation this year, that's okay. Those losses will just carry over. Okay, so you don't lose those losses. You don't have to use them in the current year. They'll just carry forward, and so you can kind of review the same thing in the following year or in subsequent years. Okay. We talked about the crypto exclusion again. That's probably not going to apply after this year. Not certain, but that's the way it looks. So. Gain harvesting, okay, just so you're aware, and not many people fall into this category, but just so you're aware, if you are married filing joint with taxable income less than $80,800, you would fall into kind of a privileged window, if you will, where you may qualify or you may have a 0% capital gains rate. So if you happen to fall in that category, I would strongly encourage you either to get with your Lifeworks advisor if you are a current Lifeworks client, or to get with your advisor or your CPA to review where you're at within that range of income. But you may, given that the market has been on such a kind of a generally good run, I know we're experiencing some rocky times here, but given that the market has been on such a good run, if you fall into this category, it may be a great time to grab some of those profits without incurring any capital gains tax. Again, not overly complex here, but it definitely requires a little bit of planning just to see where you are kind of within those income ranges and make sure that you're taking advantage of that. So gain harvesting, not something that's talked about a great deal because it's a pretty small window of folks that really applies to, but still worth taking a look at if you think you may kind of fall into that category. Okay. All right, man, we're moving. Okay. So talked about some of the charitable giving strategies. We talked about Roth conversion planning, tax loss harvesting. Look, those are all things that can generate real, tangible tax savings for you. So if you haven't given any consideration to any of those at this point, now is really the time to do it between now and the end of the year. Okay. So moving along, let's jump into, I've called it distribution planning. And there's really two key areas that I'm going to focus on here, but just a couple of things that you may already be aware of, but just a little refresher so that we're all kind of on the same page. So as a part of the Secure Act, that again was passed in late 2019, changed the required minimum distribution age from 70 to 72. Most of you, I'm quite certain, are probably aware of that, just so, again, we're all on the same page. If you are 72 and above, and you're at that point where you've got to start taking required minimum distributions, it is important to understand the aggregation rules that apply to required minimum distributions with different account types, okay? So, and really we're going to talk about 401ks, traditional IRAs, and 403Bs. So with traditional IRAs, if you have 10 IRAs, you have the option to calculate the total balance of those accounts at December 31st, calculate what your RMD will be, and you can pull that RMD from one IRA account. Okay, a lot of people are pretty familiar with that, I think, but it's important to understand it because it does help to streamline pulling those RMDs. 403Bs, okay, same aggregation rules apply to 403Bs as we have with the traditional IRAs. So you can aggregate those accounts together and pull from one account. Okay, most people generally don't have more than one 403B, but if you do, understand that those aggregation rules apply. 401ks, however, are different. So if you have 4 or 5 different 401ks that are still sitting there with former employers and you're at that RMD age, with 401ks, you have to calculate individually and pull the RMD individually from each 401k account. Okay, so that's very important because the penalties for not following those guidelines can be pretty stiff. So again, most people are aware of the IRA rules as far as aggregation. 401ks, 403Bs, not so much. So I just want to make sure that you had some guidance on that. So now, two distribution strategies that I want to spend the rest of our time in this section on. In-service distributions and net unrealized appreciation, or NUA, as you'll see it referred to. In-service distributions are, I won't say that they're common, but about 70% of plans that are in existence today do allow for in-service distributions. All an in-service distribution is, once you reach age 59 and a half, and there are some other kind of little caveat rules for earlier ages. I'm not going to get into that right now. But once you reach age 59 and a half, if you're still with your employer, you probably are eligible to execute an in-service distribution, meaning you can roll the funds out of that employer's plan and you can roll them into an IRA, but still remain an active participant in that 401k plan. So hopefully that makes sense. So 59 and a half, you're still with your existing employer. You can roll over funds into an IRA and still remain an active participant in that plan. Now, a couple things to be aware of. Number one, you definitely need to check with HR or your plan administrator to find out if your plan allows for in-service distributions. Again, 70% of plans allow for it based on the most recent statistics. I personally have not ever run into a situation where a client that's 59 and a half cannot execute an in-service distribution. We've probably, I don't know if I had to guess, I'd say we've probably done 20 to 25 of them. I've never run into an instance where they cannot. What I have run into, though, is if you go to ask HR or maybe your plan administrator, I see it more with HR, but if you go to ask, I would ask the question, get the answer, but I would also request something called the summary plan document so that either yourself or your advisor can review that to confirm what's allowed or not allowed. Because sometimes, not all the time, but sometimes asking the question, you'll get the wrong answer. I have run into that. So just be aware of that. That's called the summary plan document. for the 401k. You probably already have it online somewhere, but I would request that. So that's an in-service distribution. It's an extremely valuable tool for folks who are nearing retirement, because if you're in a bad plan, it gives you obviously more freedom and flexibility from an investment allocation standpoint. It may also reduce your fees depending on the fee structure within your plan. There have been times, full disclosure, there have been times where we have advised the client to stay in their existing plan because it's a pretty good plan, the options are fine. So you just have to, like anything else, you kind of got to analyze it and determine what's right in your particular situation. So that's in-service distributions. This next topic, we could literally probably spend an hour on net unrealized appreciation and probably not have spent enough time on it. So I'm going to try to hit the highlights here, because if somebody on this falls into this category, it is a really, really valuable planning tool, tax savings tool. So net unrealized appreciation, essentially what it comes down to is if you are in an employer plan, and that employer plan, within that employer plan, you have acquired company stock. So we'll just come up with a random example here, and let's just say IBM, okay? If you work for IBM, you're in that company plan, there's a 401k, maybe there's an ESOP or an employee stock ownership plan where you own company stock and you've owned it for a long period of time. Net unrealized appreciation allows you to move that stock out of the plan, pay ordinary income tax on the cost basis or what you originally paid for the stock, but you would only pay capital gains on the growth of that stock or of that position once you go to liquidate that position. So let's talk logistics a little bit. Okay. So there's really basically three rules that you absolutely have to follow. They're non-negotiable. You have to follow these rules in order to qualify for NUA treatment. Okay. First, the employer stock must be transferred in kind. It cannot be sold in the employer plan. It must be transferred in kind into a taxable brokerage account. Okay, so that's step one. Has to be done that way. We get questions a lot, well, I'm just going to liquidate it, move the cap. Don't do that. You won't be eligible for the NUA treatment. Okay. Step two, the entire account balance must be distributed via a lump sum distribution within a single tax year. So all a lump sum distribution is, you're not taking the cash and taking the tax. You're basically just rolling that over the remainder of the account balance into an IRA, into a traditional IRA. Just a rollover, it's not a taxable event. Okay, but that account does have to be emptied out. So you're going to transfer the employer stock in kind to a taxable brokerage account, and you're going to roll the remaining funds in the employer plan out into a traditional IRA. So that's step one. Step two. Step three, the lump sum distribution has to be made after a triggering event. So triggering events would be death, disability, a separation from service, or you've reached age 59 and a half. Those three steps, those three things have to be followed. So again, just as a refresher, so when you transfer the company stock in kind, okay, you are going to pay ordinary, so let's put numbers to it, that tends to be a little easier. If you've got a $500,000 position in the IBM stock, which was the example we used, but you only paid $100,000 for that stock. When you transfer it in kind, you're going to pay ordinary income tax, whatever your tax rate is. You're going to pay ordinary income tax on the $100,000. Okay, the $400,000. Let's just say you opted or you chose to liquidate that stock right away after you moved it. That $400,000 gain is going to be taxed at capital gains rates. So hopefully that makes sense. So you'd have ordinary income tax on the 100,000, capital gains on the 400,000. Okay, and then you would roll the remainder of the plan into a traditional IRA. So obviously, there's a planning exercise that you have to work through in order to determine the real tax benefit to you. But it obviously, if you're in the 32, 35, 37% brackets, this strategy can be extremely beneficial to you if you happen to fall in that category. Okay, so that's net unrealized appreciation. One point to make that's really important. After that stock is transferred in kind, you can hold that position indefinitely. So if you opted to hold it for 5 years, 10 years, 15 years, 20 years, 50 years, that's your choice. Ultimately, you are going to pay capital gains on the growth, whatever that growth may be at any point in the future. So hopefully that makes sense. One other very important item is that those NUA gains, the net unrealized appreciation gains that we referenced, those are not subject to the net investment tax, net investment income tax, or the NIIT. And that's a 3.8%, essentially like a Medicare surtax on investment income. So those gains are not subject to that. So it's another really valuable tax savings by executing this strategy if you fall into that category. So as I mentioned, it is a little bit tricky. It's kind of a tedious strategy to work through, but can be really, really, really beneficial if you're in those higher brackets. Absolutely 100%. If you're a Lifeworks client, get with your advisor, get with your CPA or Lifeworks advisor can get with me and we can kind of work through this. If you're not a current Lifeworks client and you happen to fall in this situation, just reach out to me. You'll have an opportunity to schedule some time with me if you choose to. But again, extremely valuable, the net unrealized appreciation. All right, making some good progress. All right. Okay, so talked about a lot of different things. Last, I guess, kind of strategy would be just some kind of updates to itemized deduction planning, if you will. As all of you are aware, because we've talked about it, I'm sure you're aware before we started talking about it, the standard deduction is so large and so significant, especially for married filing joint, that a very large percentage of taxpayers are now just taking the standard deduction. So if we wanted to have the opportunity to itemize deductions, we may need to consider something just called bundling deductions. So essentially all that means is, for example, paying multiple years worth of real estate taxes in 1 year. Paying or contributing multiple years worth of charitable contributions in 1 year. If you're not utilizing the donor advised funds, qualified charitable distributions, gifting appreciated stock, that could kind of fall into this guideline as well. But essentially just bundling some of those deductions together to try to take advantage of and increase the amount of your deductions to allow for itemizing versus taking the standard deduction. Now, one thing, and we'll talk about some of the Biden tax proposals here in just a second, kind of give you a summary review of some of that. But one thing that is extremely valuable and does look like it's going to pass on November 19th, the House did pass the Build Back Better Act, so it's going to the Senate. But as part of that, the $10,000 SALT deduction limitation, the state and local tax deduction, that $10,000 limitation, that is going to be increased to $80,000. So that's a pretty significant benefit. So, things like, state income taxes, local income taxes, sales taxes, if you're looking at, purchasing a vehicle, purchasing a boat, real estate taxes, all of those things now that were limited to $10,000, that's going to be increased to $80,000, and it would be retroactive to January 1 of 2021. Has not passed yet. It is in the Senate, so we're kind of waiting. Everyone's waiting with bated breath to see what ultimately happens. But just be aware of that, and something to keep an eye on as we work our way, through the end of the year, even into next year, because there's still a high likelihood that they would make it retroactive to January 1 of 2021. Just one other thing in terms of itemized deductions: if you are contributing or donating non-cash assets that have a value greater than $5,000, you are going to be required to get an appraisal done on those assets. The receiving entity cannot do that appraisal for you. We get that question a lot from clients. Well, they valued it. It's got to be a certified appraisal. So just be aware of that if you're donating any large non-cash assets. Okay. Okay. Wow. Really moved through that. All right. Okay. So we went through all those strategies, and again, if there's any questions on those, hit us in our little chat box. We can address those here in just a second. What I wanted to kind of address now are some of the proposed changes as it relates to the Build Back Better Act, aka the Biden tax proposals, whatever you want to call them. So there's a lot of changes in there. For our purposes today, I'm really only going to focus on two areas. One are the income tax changes, and the second are the changes to retirement plans. So as a lot of you are probably aware, there were some pretty significant proposed increases to capital gains taxes. As it stands now, based on the legislation that was passed through the House, the 20% capital gains rate is going to stay. So at one point it was up 39.6, it was 25%. It's going to stay at the 20% rate for now. So that's good news. Also, the top income tax bracket was going to bump up to the 39.6%. That also is going to stay at the current 37%. So that's also good news. A couple of other changes, if I can find my notes. A couple of other changes that are that could impact some of you on the small business side. S corporation net income has not been subject to the 3.8% that net investment income tax that we talked about a second ago. S corp income has not been subject to that, at least based on what was passed through the House. That is going to be a change that's going to come into play. So that's that could affect S corp owners. There are also some changes coming to retirement plans, specifically as it relates to Roth conversions. One of the things that is, I'm shuffling around here trying to find some notes. One of the things that's going to happen with Roth conversions specifically, if you have an income in excess of $450,000, the Roth IRA conversion is not going to be available for you, but that won't go in effect until 2031. So it's basically, it just gives you a 10-year planning window to kind of plan for that and prepare for that. There are a lot of other changes in the Biden tax proposals, but for the time being, those are the ones that are probably bearing the most weight at this point in regards to income taxes, retirement plans, and how folks kind of need to plan and prepare for those. Nothing is finalized yet, so we are, again, waiting kind of with bated breath to see ultimately what happens. But for now, those are just some kind of quick hitters so you understand where we stand with the Build Back Better Act. So that really is everything that we wanted to ultimately kind of try to get through. What I would encourage you to do is, if you are a current Lifeworks client, if you have any questions at all on any of these strategies, anything that we've discussed, or any other questions for that matter, reach out to your Lifeworks advisor. But also rest assured that these are all strategies that have been discussed, kind of within the Lifeworks family, and that we're, working on with clients. But again, if you're a Lifeworks client, get with your advisor, make sure that all of these things are being handled. If you are not a current Lifeworks client and you have questions or concerns in regards to these, feel free. You've got an option to jump onto my calendar and schedule some time, directly with me. I'm happy to chat. Obviously, we've got about a 30-day window to implement some of these. So feel free, jump in, schedule that time, and let's see if we can help, or move through these things with you. So at this time, we are going to take a look at some questions that have come in and try to get those answered for you. I'm probably going to be looking off to my left quite a bit just to take a look at those questions, but we'll see kind of what we can get answered here. All right. So let's see. All right. So what advantage am I getting for running a donor-advised fund through Lifeworks? How is it better than donating directly to the organization? Okay, so that's the first part of the question. So let me address that. So first and foremost, so full disclosure, because this isn't a sales pitch. Obviously, you can establish a donor-advised fund through Lifeworks. You can also establish them through a lot of other organizations. The question specifically is, what is the advantage of running a donor-advised fund through, I'm just going to say through an organization, Lifeworks being one of those. And how is it better than donating directly to the organization? So you have the ability, when you donate to a donor-advised fund, you can put those funds in and generate the tax deduction. But you don't necessarily have to make any of those donations out to charitable entities right away. So the advantage from my perspective that it gives you is it allows you to make a contribution, generate the deduction, but give yourself some time to think through and research different organizations that you may want to contribute to. And I say that it's a very serious thing when you're donating to a particular organization. Now, you may have an organization that is very close to your heart that you're going to contribute to, and that's fine. But not everybody's in that situation. And I always encourage anybody that's donating to understand how much of your money is actually going to benefit that charity. And that takes a little bit of due diligence. Not everybody does that, and that's okay. But I do think that's an important aspect of contributing to an entity. So that's one advantage, is it gives you time to do some due diligence, to learn about the entities, and to kind of craft a giving plan, if you will, while still getting the deduction in the current year. The second advantage, again, of doing the donor-advised fund, and I think one thing that we didn't touch on, so I'm glad you asked this question, is when you invest in a donor-advised fund, you are doing just that. You're investing. So you have the opportunity to almost kind of create a little kind of a mini endowment fund, if you will, where that growth over time allows you to contribute more to different entities that are close to your heart. So that is one of the probably most notable advantages, as opposed to just donating directly to one particular organization. You could put 20, 50, 100, 200,000, however much you want, into a donor advised fund and allow that to grow over time. Okay. Let's see. Okay. So what if I open a donor advised fund with 25K minimum, which is that is the Lifeworks minimum, in 2021 before year end, donate 24 of that to charitable organizations? Does that create a problem having only 1,000 left in that account? Is that the way it is supposed to be used? So there is a $25,000 minimum when you set this up through Lifeworks. A lot of groups have some type of minimum. If you were to donate the 24,000 before the end of the year, that's fine. There's no issue with that. If it drains it down to $1,000, what would happen is you do have to maintain basically a $10,000 balance. Again, I'm speaking from the Lifeworks perspective here. You do have to maintain a $10,000 balance. So essentially, the donor advised fund itself would reach out, say, hey, we need to get this back up to the $10,000 limit. And generally, you're going to have some time frame to do that. So a lot of times what we'll see with donor advised funds is a contribution will go in, and then it might sit for 6 months, a year, 2 years, and slowly come out of it as you identify entities to contribute to. So hopefully that answers that question. Let's see. So does it ever make sense to do a Roth conversion that exceeds your current tax bracket? I would say generally no, but there might be a scenario where by going up into the next tax bracket, maybe you know that you have some unusually large income events coming within the next few years. Maybe you know there are some tax increases coming your way, whether they're state or federal. And so from that perspective, it could make sense to do that. I will go back to the original point that I made, that you need to have a multi-year plan. In each year, you're going to review that plan. So in a particular year, we may sit down with a client and say, look, you're in the 24% bracket. If we convert this much, you're going to bump into the 32% bracket, but you had over withheld on a W-2, or we already planned for that and made some estimated payments. So again, it would just have to be a review of a particular year within that multi-year plan. But I really can't stress enough, I think Roth conversion, any Roth conversion should be done as part of a multi-year approach. So, all right. The QCD cannot go to the DAF, right? It must be a direct charity, not a holding bucket like the DAF. So that actually is correct. So the qualified charitable distribution cannot go to the donor advised fund. It would have to go, so your contribution would go into the donor advised fund, which is not going to come from your IRA. Now you could take a distribution out of the IRA and then make a contribution in the donor advised fund, but you're probably just better off doing the qualified charitable distribution. That's a great question. The direct answer is you're correct. Yes. Okay. For NUA, is there a typical appreciation amount you'd like to see to have it make sense? For instance, at least 50%. I have shares purchased in the last few years that have little escalation. Can I only convert via the NUA, the low cost shares? Okay. So this is a really good question. Typically, the NUA is going to make the most sense when you have highly appreciated positions. It would be really tough for me to recommend going the NUA route if there's not real tangible tax savings. So if, to your point, let's see, for at least 50%, I have shares purchased the last few years that have little escalation. That probably wouldn't make sense because it is kind of a tedious strategy. There's a little bit of a hassle to doing it. And again, if you have very little escalation, then that capital gains savings, also depending on what tax rate you're in, it just may not be worth it. There just might not be enough tangible tax savings to warrant doing that. I hope that answers that question for you. What's the advantage? What are the advantages, disadvantages, advantages and disadvantages of a DAF versus a QCD? Okay. So really kind of two separate scenarios. The QCD is going to be specific to an IRA account where you're pulling money out of an IRA and you're directing it to a particular charity. The QCD, from my perspective, it generally makes the most sense if you're above age 72 and you simply don't need the required minimum distribution. If you just don't need that to live on. So, and you're a charitable person, which some are, some aren't. That's okay. That's fine. But if you're below 72, there's really no reason to pull the money out of the IRA because you don't have to, if that makes sense. So QCD is really just specific to a scenario where you're above 72, don't need the required minimum distribution. The DAF is really going to be when you have excess cash on hand, again, an unusually large income event, or we know you are a charitable person, you're giving $10,000, $15,000, $20,000 a year, but it's not really enough to bump you into itemizing, so you're just taking the standard deduction every year. We may expedite those and take 5, 6, 7 years worth of deductions in 1 year. So the disadvantage of a qualified charitable distribution based on how I would typically use it, I wouldn't really say that there is a disadvantage because you're just taking money that you don't need and giving it to a charity that you would give it to anyway, and so you're avoiding it being reported in your income. The donor advised fund, I would say the primary disadvantage of a donor advised fund is that contribution is irrevocable. Once you decide to put it into the DAF, you can't get it back. So you kind of lose control. You can't spend that money anymore. But the advantages, again, in my opinion, far outweigh the disadvantages because now you've got essentially, like I said, kind of a little endowment fund that you have created. You've taken the deduction in the current year. You've got those contributions that can be made over time. You're under no requirement to make those contributions or those donations immediately after it's in the fund. And you get the advantage of the growth that's tax-free, which only goes to benefit those charities more in the future. So I hope that answers those questions. Got anything else? Two more. Okay. Is there any movement to change? Is there any movement to change the stepped-up basis on inherited assets to a pass-through basis? I'm assuming that you're maybe referring to the Biden tax proposals here. So I don't know that I can answer that question specifically. You're welcome to reach out directly. There was discussion of eliminating the stepped-up value and basis via the Biden proposals. I do not believe that was in the bill that passed through the House. I can find that out, though, if you'd like, and I can get you more detail on that. So hopefully that helps some. All right, when gifting appreciated stock, what is the value of the deduction? The original cost or the value as the contribution? So it's the value as of the contribution, which is part of the advantage of giving it, because you're getting, so I'll give you an example, and I think I skipped over this before. So if you had a $10,000 position that you had originally, a fair market value, that you originally paid $2,000 for, so the $10,000 total value of the position. If you gift that, that's going to be what the deduction is based on. So let's just say you're in the 35% bracket. So that would be a $3,500 tax benefit. Again, assuming that you itemize, that would be a $3,500 tax benefit. But then you're also avoiding $8,000, or I should say $1,200 of capital gains tax, $8,000 of gains against, well, if we're saying short term. Anyway, you're saving the capital gains tax hit. So to answer your question directly, it's based on the value of the position, not what you originally paid for it. So I hope that answers that. So, wow, just a lot of great questions. So 1st of December, and we're ready to go. We're ready to get some planning in. So listen, thank you so much for spending some time with us and sharing great questions, sharing such great engagement. As I mentioned, if you are a Lifeworks client, do not hesitate to reach out to your advisor. But again, rest assured, these are all things that are being discussed and addressed kind of behind the scenes for a lot of clients. If you are not a current Lifeworks client, and there's anything here that you have additional questions about, you're curious about, what some of these planning engagements may look like, or how we would work with you, feel free to, you've got that link to jump on my calendar, schedule a time directly with me, and we can set up a call and work through that with you, and be happy to chat. And oh, it looks like we got another question. If tax deduction goes to 80K real estate plus sales tax, would it be a good idea to pay off my car loan? So it's always a good idea to get rid of debt, but paying off that debt would not have any benefit to you from a tax standpoint. When you purchase the vehicle, that's when you would receive the benefit of the sales tax deduction. Paying off the vehicle doesn't generate any additional deduction. So hope that helps. Awesome. So I think that's it. Again, don't hesitate to reach out, schedule a time. Happy to chat. And obviously, happy holidays. Hope everyone had a great Thanksgiving, Christmas coming up. Hope everyone has a great end to the year.